Let's then look at the long-term loan. Again, I broke this calculation into two steps. In step 1, we are going to calculate our cash flows. And please remember, in step 1, when you are calculating the cash flows, we ignore tax and transaction costs. So for the loan, we know that it bears interest at prime less 1.5%. So if the prime lending rate is 10%, prime less 1.5% is going to give me 8.5%. So if I want to calculate my interest cash flow, which is exactly what we are doing in step 1, in step 1 we are calculating our cash flows, that means I need to use 8.5% as my interest rate. We know that the original loan amount was 12 million rand, so that's going to be my present value. We also know that the loan is repayable in 8 equal biannual installments, so N is going to equal 8. And this is paid biannually, guys. It's made up of interest and capital. So we are going to be solving for our payment, and the future value is going to be 0. So the interest and capital is not all repayable at the end of the period. So the future value is 0. There's nothing payable at the end. Instead, it's in 8 equal biannual installments. So we are going to solve for the payment. So my present value is 12 million. And that would have been the present value when they first entered into the loan agreement on the 1st of March 20X2. We said that N is 8, and please note that is made up of 4 years. So it's a 4-year loan, but we have 2 payments per annum. So that's where the 8 comes from. For I, remember we are trying to calculate our cash flows. When you are trying to calculate your interest cash flow, you must use your coupon rate. So what is the coupon rate? It's 8.5%. It was prime less 1.5%. Now please note that 8.5% is an annual rate, and you need to be consistent. We are making payments twice a year. So if N is 8, in other words, we've taken 4 years and we've multiplied by 2 to get to 8, then the coupon rate must also be the rate for a 6-month period. So I need to divide this by 2 so that I have a coupon rate of 4.25% for each 6-month period. So you are being consistent. This is 8 6-month periods, and that is the coupon rate for a 6-month period. So we are not using 4 years and a rate of 8.5% per annum. We are using 8 payment periods with a rate of 4.25% per payment period. Then we said everything is going to be paid in equal installments over the loan period, all of the interest and all of the capital. So we are going to solve for our payment, and the future value is going to be 0. You only have a future value if everything is repayable at the end of the loan period. So in this case, our future value is 0 because everything is repayable in 8 equal installments. So if you put all of this into your financial calculator, you are going to get a payment of 1,800,779. So guys, the purpose of step 1 was to calculate our cash flows. And we now have all of the cash flows. up front, when the company first entered into the loan agreement, they would have had an inflow of 12 million rand. And then over the next 4 years, they are going to make 8 payments in order to settle this loan. And this payment over here is made up of interest and capital. So we've calculated all of our cash flows. We ignored tax. Look at the calculation. We did not multiply here by 72%, etc. You ignore tax in step 1 of your calculation. And if there are any transaction costs, you also ignore those transaction costs. We only take tax and transaction costs into account when we get to step 2 of our calculation. So now that step 1 is complete, we can move on to step 2. And in step 2, we will actually calculate the market value of the loan. And please note, when calculating the market value, that is just the present value of our future cash flows. So we are going to look at all of the future cash flows, which we already calculated in step 1. So that's why in step 1 we first had to get the cash flows. Now that we know what our cash flows are, we will present value the future cash flows, and we then have the market value of the loan. Now please note, guys, the company entered into this loan agreement on the 1st of March 20x2. However, in the required, we are calculating the weighted average cost of capital at the 28th of February 20x4. Now, please note, we are only looking at future cash flows when we calculate the market value. So any cash flows that happened in the past are ignored. So let's look at this on a timeline. The company entered into the loan agreement on the 1st of March 20x2, and they make biannual payments. So every 6 months they have a payment. So the first payment would have been made at the end of August 20x2. The next payment at the end of February 20x3. Then again on the 31st of August 20x3, 28 Feb 20x4, 31 August 20x4, 28 Feb 20x5, 31 August 20x5, and lastly 28 Feb 20x6. So those would be the 8 payments. We are calculating the weighted average cost of capital at the 28th of February 20x4. So at this point in time over here. At this point in time, we've already made 4 payments, and there are only 4 payments remaining. What are my future cash flows? Cash flow 5, 6, 7, and 8. Those are my future cash flows. Everything else is past cash flows. So when I'm calculating my market value, the market value is just the present value of your future cash flows. So all we're going to do is we are going to take these future cash flows that we have over there, and we are going to present value them so that we have the market value of the loan today at the 28th of February 20x4. So we are calculating the market value today. Today is the 28th of February 20x4, and we only look at our future cash flows. We ignore past cash flows. So what are my future cash flows? That is the payment I'm going to make over the next 4 periods, or in other words, period 5, period 6, period 7, and period 8. Only look at future cash flows, ignore past cash flows. So we don't put anything in this column over here, only look at the future cash flows. This is my current date. This is where I'm currently sitting. Only look at the future cash flows. So what are we trying to do? We are trying to get the present value of those future cash flows. Now please note, these cash flows that I have over here ignore tax, because in step 1, when I calculated that cash flow, I ignored tax in my calculation. So it's very important tax has been ignored. We now need to take tax into account. We know that the interest is tax deductible in terms of Section 24J of the Income Tax Act. So we are going to get a tax benefit on that interest at 28%. Now, the easiest way to do this calculation, you already have all of this information above in your financial calculator. Keep that information in your financial calculator, and you are going to use the amortization function in your financial calculator. So keep all of the information in there. Let's show this now as a separate calculation. Using your amortization function in your calculator, I want you to pull out the interest for periods 5, 6, 7, and 8. Now remember, even though you're using your financial calculator, you must still write down your calculator steps. So you can see I am writing everything down. Don't just perform the calculation on your calculator and write down the solution. You're going to lose out on marks. If you are not writing out the amortization table, but instead you're using the amortization function on your calculator, you must write down your calculator inputs. So what is the interest for period 5, 6, 7, and 8 as per your financial calculator? So that is the interest as per the financial calculator. So we said, what does Section 24J do? We get the tax deduction for interest as it accrues over the period. So this is how the interest accrues over the period. So this is how I'm going to get my tax deduction or my tax benefit. So all I need to do now is I need to multiply this by 28%, and that will give me my tax benefit in each of those years. So take the interest amount, multiply it by 28%, and that gives you your tax benefit. And then please just make it clear that we've been using the amortization function on your financial calculator. Right, that's definitely the quicker way of doing it. If you actually write out your amortization schedule, that's going to take a lot of time and it's not worth that many marks. So you don't have enough time to write out the whole table. At this level, you must know how to use your financial calculator. So once again, the market value is just the present value of your future cash flows. So we only included future cash flows in our calculation below. In step 1, we calculate the cash flows. In step 2, we present value those future cash flows. And then please note, we just need to take tax into account. In step 1, we ignored tax. In step 2, we now take that tax benefit into account. And please note, it's a benefit. So you show this as an inflow. Each of these over here are shown as an inflow. The company will save tax with their interest deduction. So it's a tax benefit or a saving from the company's perspective. So we've now taken into account the fact that interest is deductible in terms of Section 24J. We've done that. And please note, the capital portion will not be tax deductible. So if you go back to your rules that you cover in your tax syllabus, only the interest portion is tax deductible, the capital portion is not. So that's why we need this amortization function in our calculator so that we can just get the interest portion. We calculate the tax saving on the interest. The capital repayment is not tax deductible. So we can then total our cash flows. And then once again, you must show your calculator inputs. So we are going to use the cash flow function on our calculator. The first cash flow that you input is 0. So the cash flow right now at the 28th of February 2014 is 0 because you only look at future cash flows, not your current and past cash flows. So please show that because your first input must be 0. If you start inputting over here, then you're going to get the wrong answer. The first input must be 0. Then you can input all of your other cash flows. Then what is I going to be? Please remember, when we are trying to calculate the market value or the present value, we always use the cost of debt as our discount rate. So we need to get the cost of debt for this loan. So if we go back to the information provided in the question, the market-related rate or the cost of debt was 9.5% per annum. Then please remember, our cash flows over here are after tax, because we are dealing with debt and interest is tax deductible. So whenever we are dealing with debt and interest, our cash flows must be after tax and our cost of debt must also be after tax. You need to be consistent. So that gives me an after-tax cost of 6.84%. Then in addition to that, please note this 9.5% that they gave you was the rate per annum. These cash flows over here are not annual cash flows. Those are cash flows every 6 months. So again, you need to be consistent. Your discount rate that you are using over here must match your cash flows. So first, the cash flows are after tax, so the discount rate must also be after tax. Then the cash flows are for a 6-month period. So what we need to do is divide this by 2 so that the discount rate is also for a 6-month period. So if you input all of those cash flows into your financial calculator and you use 3.42% as your discount rate, you will then solve for the present value or the market value of the loan. All right, and then the last type of finance we had in this question was the bank overdraft, but you'll remember I said we don't include that in our WACC calculation because it is used as short-term finance and our WACC is a long-term calculation. So we've now calculated the cost and the market value for all of the different types of finance. We can now wrap everything up and calculate our weighted average cost of capital. So first, for each type of finance, we did calculate the market values. So just bring the market value forward from each of your previous calculations. We then need to get a total, so you can add all of those together. Now remember, the purpose behind calculating the market value is we are going to use that for our weighting, because in this question we were not given the target capital structure. So we now need to calculate our weighting. If you are given the target capital structure, you won't need to calculate market values. You will just use the target capital structure as your weighting. So, for example, they might have told you that their target is 50% equity, 10% preference shares, 20% debentures, and 20% loans. Then you use the target. In this case, we were not given the target, so we calculated market values, and we are now going to calculate the percentages based on these market values. So what you need to do is take the market value of equity and divide by the total so that you can see what percentage relates to equity. So equity is 63.4%. And you do the same thing for all of the other types of finance. Take the value of the preference shares, divide by the total, and that gives me 9.9%. The debentures give me 14.5%. And lastly, the long-term loan gives me 12.2%. So obviously, the total of this weighting will add up to 100%. All of the capital within the company, we are just looking at how it is split between equity, preference shares, debentures, and the long-term loan. And guys, I recommend you write out this 100% over here because there are sometimes marks awarded for that amount. So please write that out. Then we need to bring the cost down. And once again, we have already calculated the cost for all of the different types of finance, so you can just bring it down. The cost of equity was 22%. The cost of preference shares was 8.86%. For the debentures, please remember, we said the debentures are going to convert into ordinary shares, so we are not going to use the cost of debt. Instead, we are going to use the cost of equity when we perform our WACC calculation. And then lastly, for the long-term loan, please note, you now need that annual rate. We want the after-tax cost of debt, not the rate for a 6-month period, but the annual rate of 6.84%. All right, and we can then calculate our weighted average cost of capital. So all you need to do is you take the weighting, you multiply by the cost, and that gives you your WACC. And you do that for each type of finance. So we get a weighted average cost of capital of 18.85%. Then guys, I recommend, just in case, because you don't know what the mark plan is going to look like. So they gave us information relating to the bank overdraft in the question. We didn't use the bank overdraft in our calculation because it's short-term in nature and the WACC is a long-term calculation. However, if you just ignore it, the examiner doesn't know that you're ignoring it for a reason or if you just forgot to include it, etc. So never just ignore anything. Because we haven't included it, let's just state why we haven't included it in case there is a mark available for that on the mark plan. Sometimes there is, sometimes there isn't, so just make sure you cover all of your bases. So the bank overdraft is used as a form of short-term finance and is therefore excluded from the WACC calculation. Okay guys, that then brings us to the end of this tutorial question. Thank you very much.